Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, it's been a split focus for investors this week. Middle East conflict, of course, being never far from the headlines, but for equity markets, it was really the earnings that dominated the narrative. So, as I mentioned recently to a colleague, we now have oil above $100 and equities are at record highs. So, can they both be right? So, to discuss this and more, today I'm very happy to be joined by Ray Heung, who's a senior investment strategist at the CIO office. Welcome, Ray. Let's start on the earnings side of that balance. So, in your view, what are the key takeaways from the US first quarter earnings so far, particularly from the tech sector?
Thank you for Manpreet having me. I think we view that the U.S. earnings seasons are providing fundamental support to our overweight view on the U.S. equity and in particular the tech sector, as well as our opportunistic idea on the global semiconductors. Now, if you take a look at the S&P 500 results from the first quarter 2026, I guess, one third of the companies reported is actually showing 81% of them beating the consensus estimate, which is well above the average beat rate of about two-thirds, right? And so if you also focusing on the earnings growth for the quarter one earnings, literally now they are expected to grow by 16% year on year, while the full year earnings are now expected to grow by roughly 20%. And both numbers were revised up before the start of the earnings season. In particular to the tech sector, several major tech companies announced earnings this week, delivering very solid overall results. And we view that there are two critical AI data points to support the strength of the major tech companies. Number one is actually the AI capital expenditure, and secondly is the AI monetization, right? For the AI capex, we are seeing further upgrades following management guidance, and we are now raising our estimate for the global AI capex growth to 30%, up from 27% annual pace for the year of 2025 through 2030. On the AI monetization front, it also came in ahead of expectations, with solid growth of 38% year on year in the first quarter of 2026 for the top three cloud platforms.
All right, thanks, Ray. I think some interesting numbers from the tech sector, but staying with equities for a moment, what's your view on gold mining equities and I guess the broader material sector?
Okay, now, if we are looking at the recommendation side of the equation, we recommend investors to add exposure to gold miners with their robust earning outlooks and also reasonable valuations. Our thesis on gold has actually not been changing, meaning that our bullish gold outlook continues to be driven by compelling structural drivers, including central bank buying gold as a hedge against macro uncertainty, the persistent inflation concern, and also declining real interest rates. We also think global gold mining stock offer leverage exposure to gold prices with the equity style upside. Now, higher gold prices will expand margins by lifting realized prices, while all-in sustaining costs to extract gold tend to adjust a little bit more slowly. And therefore, despite in the near term elevated energy prices may pressure operating costs and margins, we believe investors should look through the near-term volatility-driven market. So gold miners are well positioned to benefit from the supported macro as well as the policy conditions. On the material sector for the U.S., we currently maintain a neutral stance, but as mentioned, we like the gold miners within the sector, but overall stance is still neutral for the material sector. The reason our performance of the sector is driven by rising commodity prices as well as the capex momentum. In particular, if we look at the incremental demand from the AI infrastructure and the energy transitions, generating meaningful demand for copper and also aluminum. And this has also contributed to strong earnings momentum as we saw consensus 12-month forward earnings growth for the U.S. material sector is now 28%, up from 21% earlier this year, making one of the strongest near-term trend across the sectors. However, I think the chemical industry within the larger sector and the rest of the segment continue to weigh on a more positive view due to this more modest earnings growth.
All right, let's move to a bit of policy here. So we also have a number of central bank decisions this week. Of course, the BOJ and the Fed. So what do you see of interest there, and specifically on the BOJ? Any impact on the dollar yen currency pair?
Thanks, Manpreet. I think yes. The Fed and the BOJ held rates unchanged this week, and this is actually followed by the ECB and BOE, which are likely to follow suit also later today. But before answering your question on dollar yen, I would actually like to point out that we expect policy divergence later this year, with the U.S. Fed to cut rates later this year to support the job market. Right now, the ECB, BOJ, and BOE are likely to hike interest rate to counter inflation pressure, and this policy divergence is likely to extend the dollar weakness. So now back to the dollar yen. The upward revision in inflation estimate in Japan is actually growing dissent among the BOJ policymaker, and that supports our view that the BOJ will hike rates by 50 basis points to 1.25% by December this year, which is currently in line with money market pricing, and also that would be underpinning our bearish dollar yen stance. We think the dollar yen has been range bound following the BOJ decision, and because this was driven by the absence of any unexpected policy move in this time around. So although the BOJ has revised its inflation expectation upwards, and that should support the yen more, this positive effect is actually tempered by the persistent concern about economic growth and the potential risk of stagflation. So from a technical standpoint, I think we view the dollar yen upside to be rather limited, with persistent evidence in the 160 to 162 dollar yen area. Also, a level with high intervention risk is actually happening in around 160, right? So immediate support in terms of, if we're talking about a bit of downside, would be around 157, which is about the 100-day moving average for the pair. We do expect the dollar yen to fall towards a 152 yen to the dollar over a 12-month period, as the BOJ eventually will hike interest rate while the Fed to cut rates.
All right, and then finally, we obviously spoke about equities and FX, but maybe on bonds. Do you see any investment opportunity emerging in the Middle East or GCC region?
Yeah, I think the GCC region obviously is in the current heart of the conflict, right? So investors have been reassessing the regional risk, pushing the risk premium slightly higher. We believe this repricing actually creates selective entry points for investors that are comfortable with the near-term volatility. And in the region, we would focus a little bit more on the IG sovereign over high yields, and also for bonds in the short to medium term maturity, where we think that the spread and the sovereign fundamental would compensate for potential headline risk. We are cautious on property sector, however, which is vulnerable to cyclical downturns and in the regional capital inflows and also the population growth dynamics there. We are constructive more towards the regional large banking sector, however. We think that the risk of capital outflow and asset quality deterioration definitely warrant monitoring, but the GCC bank's domestic focus and sovereign and quasi-sovereign funded deposit base provide quite meaningful resilience, making the bonds attractive at the current yield premium levels.
All right. Well, thanks, Ray. I think that just about brings us to the end of time available today. Thank you for taking the time to speak to our listeners. If I can sort of summarize the top takeaways, I think number one, earnings are clear positive and very supportive of our overweights to US equities and the technology sector. Second, within equities, the other sector or opportunistic idea rather that we think is interesting and attractive today is the gold mining equities, which is our preferred area within materials. And third, within bonds, we do see some opportunities emerging in GCC bonds. Our preferences, of course, sitting in the high quality investment grade sovereign sectors and the large bank sectors. So that's all from us today. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.